The AI trade looked dead, and then it didn't. Just a few months into 2026, what felt like a slow-motion funeral for one of the most hyped investment cycles in modern history suddenly started showing a pulse again. Let's back up, because this story didn't start in January. It started with the kind of irrational exuberance that makes economists nervous and retail investors dangerous. Somewhere between AI will change everything and AI already changed everything, the market got ahead of itself, and the correction that followed wasn't a surprise to anyone paying attention to valuations. Think of it like ordering a house that hasn't been built yet and expecting it delivered tomorrow. The demand is real, the product is real, but the timeline was always a fantasy. When DeepSeek dropped cheaper reasoning models and investors started questioning whether the infrastructure build-out was justified, the air came rushing out of the balloon faster than anyone wanted to admit. What's fascinating and slightly absurd is how quickly AI winter became the narrative, even as hyperscalers kept signing billion-dollar contracts and chip orders kept climbing. The gap between the story the market was telling and the story the balance sheets were telling became one of the most interesting divergences in recent memory. Now, enter earnings season, the great truth teller, the courtroom where hype meets reality. Nvidia just posted revenue acceleration that would make a rocket ship blush. And they're doing it while trading at roughly 23 times forward earnings, which for a company with their growth profile is almost suspiciously reasonable. Broadcom is quietly playing a different game. They're not just selling chips, they're embedding themselves into the custom silicon roadmaps of the biggest hyperscalers on the planet. When a company can project over $100 billion in annual revenue from AI compute units alone by 2027, you start to understand why the market gives them a premium multiple. Taiwan Semiconductor, TSMC, is the company everyone forgets about until they remember that almost nothing in AI gets built without running through their fabs. They reported 45% year-over-year revenue growth in March alone, which is the kind of number that doesn't show up in mature industries, that shows up in super cycles. SoundHound AI is the wild card in this group, and wild cards are either the most exciting or the most humbling part of any portfolio, depending on when you check the price. They're down roughly 70% from peak, but they posted 58% revenue growth from generative AI and audio recognition software, which is the kind of contradiction that either resolves beautifully or reminds you why position sizing exists. And then there's Nebius, a neocloud data center company that has surged over 400% since early 2025 and has analysts projecting 522% revenue growth in 2026. Yes, you heard that correctly, and no, that number doesn't get easier to say out loud. Here's the historical lesson every AI cycle teaches, and every generation has to relearn personally. The money isn't always made in the first wave of hype. It's made in the consolidation phase when the survivors become undeniable. We've seen this in semiconductors in the 90s, in cloud computing in the 2010s, and we're watching it happen again in real time. The misconception worth killing right now is that AI softening means the thesis is broken. It doesn't. Cyclical pullbacks in transformative technology sectors are as normal as gravity. And the investors who mistake volatility for invalidation are the same ones who sold Amazon in 2001 and called it a rational decision. What separates the people who actually build wealth in these cycles from the people who collect great stories about almost wins is discipline, sizing, and the emotional maturity to not confuse conviction with concentration. You can believe in Nvidia and still not put 70% of your portfolio in it. In fact, if you believe in Nvidia, you probably shouldn't, because that kind of concentration punishes you for being right at the wrong time. The broader truth here is that AI infrastructure is following the same arc as every general purpose technology that preceded it. Electrification, the internet, mobile, and the early volatility always feels existential until suddenly it just becomes the background of daily life. We are still extraordinarily early in that transition, and the Q1 earnings cycle is the first real data point suggesting the resurgence has legs underneath it. So where does that leave you? Watching 5 stocks, Nvidia, Broadcom, TSMC, SoundHound, and Nebius, each representing a different layer of the AI stack, from foundational silicon to cloud infrastructure to software applications, and each telling a slightly different story about risk, reward, and how much uncertainty you can stomach with a smile. The portfolio that wins this decade probably isn't built on perfect timing. It's built on process, patience, and the humility to know that being early and being wrong look identical until they suddenly don't. And showing up consistently is the only edge most of us will ever actually have. And whenever you're ready to put that same disciplined mindset to work beyond the stock market, whether that's real estate investing, home contracting, or connecting with the right lenders, check out our links in the description below.